This comprehensive investment analysis focuses on Azimut Holding SAP, AZM.MI, a leading independent Italian financial services group specializing in asset management, wealth management, investment banking, and fintech services. The firm is strategically positioned at an inflection point, pivoting rapidly from a predominantly Italian-centric model toward a globally integrated platform capable of sustained high growth. 1.1 Core Investment Thesis. Azimut represents a compelling long-term investment opportunity among European financial services firms characterized by superior financial quality, unparalleled asset-gathering momentum, and a stock valuation that appears disconnected from its intrinsic growth trajectory. The core investment thesis posits that the market currently misprices the future recurring earnings potential derived from two major strategic growth drivers. Structural international expansion, leveraging its integrated B2B2C model, particularly in the U.S. through the North Square Investments NSI acquisition. Domestic de-risking and transformation. The strategic spin-off and partnership surrounding the creation of TNB, a new digital wealth bank, which locks in significant guaranteed fee income over the next 2 decades. Azimut is positioned to capitalize on powerful structural trends, namely the global shift of top financial advisors toward independent platforms and increasing client demand for sophisticated, actively managed private market solutions. 1.2 Key Findings Snapshot. The analysis reveals exceptional operational and financial strength. Financial health. Azimut maintains an exceptionally robust capital structure, evidenced by a near-zero debt-to-equity ratio of 0.01%. Profitability metrics are superior, with return on equity, ROE, consistently exceeding 26%. The TTM operating margin remains high at 52.76%. Growth momentum. The firm demonstrates exceptional capabilities in attracting new assets. Year-to-date, YTD net inflows reached 15.3 billion euros by September 2025, significantly outpacing listed Italian competitors. Management aims to nearly double the asset base by 2030. Valuation. Despite high-quality earnings, Azimut trades at a substantial discount relative to key domestic peers. The normalized PE ratio is low, ranging from 7.16x to 10.49x. While the current analyst consensus price target of 35.06 euros 14 suggests limited immediate upside plus 0.59%, this average target appears to underestimate the long-term value creation potential inherent in the major strategic transactions, TNB and NSI. The low PE multiple relative to its high debt-free ROE and exceptional growth trajectory offers a compelling entry point. Corporate Profile and Strategic Moat Analysis. 2.1 Independent Global Business Model. Azimut Holding SAP distinguishes itself as a large, independent, publicly held financial institution operating across asset management, wealth management, and investment banking. Its core competitive model centers on integrated asset management and distribution hubs, facilitating powerful synergy between product development and client advisory services. Geographically, while its corporate office is located in Milan, Italy, 15, the group has successfully established a globally balanced network. Management hubs are strategically positioned on every continent, including Europe, Latin America, the United States, the Middle East, and Asia. This international presence allows Azimut to offer a distinctive global model, providing highly diversified portfolios that adapt to the varied needs and regulations of institutional and retail clients worldwide. 2.2 Diversified revenue streams and asset base. The financial stability of Azimut is underpinned by the structure of its revenue base, a majority of which is derived from recurring fees generated from assets under management, AUM. 12. This recurring revenue stream provides a foundational layer of stability, which was augmented in fiscal year FY 2024 by solid growth of 11% year-over-year in recurring fees. 17. The investment offering is highly diversified, spanning both public and private markets. 1. Products include Italian mutual funds, Italian hedge funds, discretionary portfolio management, pension funds, and a growing suite of alternative funds. 15. As of June 30, 2025, the group managed total assets of €112.8 billion. 11. 2.3. Competitive positioning and structural advantages. Azimut operates within the highly competitive financial services sector, contending with large integrated banks, e.g. Banca Mediolanum, a domestic peer, and specialized global alternatives managers, e.g. Partners Group Private Equity. 15. The group's independent structure provides a significant structural advantage, distinguishing it from traditional bank-affiliated models prevalent in Italy. This competitive differentiation allows Azimut to effectively capture powerful, accelerating structural trends. Specifically, the shift of top financial advisors away from bank-owned networks towards independent, advisory-driven platforms continues to gain momentum. 3. Azimut's globally integrated advisory model, which synergizes its asset management and distribution hubs, 1, is perfectly structured to attract high-quality advisors and capture the ongoing intergenerational wealth transfer that is expanding the addressable client base, particularly in high-potential markets such as the US and Australia. This long-term trend reinforces Azimut's strategic defensibility against traditional competitors. The composition of the firm's asset base highlights its diversification and recent successes in high-growth areas. 3. Analysis of asset gathering and strategic growth pillars. Azimut's strategic plan is built upon a foundation of superior asset accumulation and ambitious structural projects designed to scale the business globally and optimize its domestic market presence. 3.1. Exceptional net inflow momentum. The group has demonstrated exceptional success in asset gathering, confirming its leading position in the Italian asset management industry. In September 2025 alone, Azimut recorded total net inflows of €1.9 billion, bringing the year-to-date total to a massive €15.3 billion. 10. This achievement highlights the accelerating demand for Azimut's product offering. By the end of June 2025, YTD net inflows of €9.0 billion had already achieved 90% of the full-year target, which was set above €10 billion. Crucially, management notes that these inflows are approximately double those of its listed competitors in the Italian market. 11. Underscoring a significant competitive edge. Of the September 2025 inflows, $1.2 billion, or 66%, were directed towards managed solutions. 10. Confirming a strategic focus on higher margin, actively managed, and customized products. 3.2. Private markets leadership and innovation. Private markets represent a central pillar of Azimut's product strategy. The demand for alternative funds remains robust. 11. Supported by strong contributions from the private market space. Historically, net flows into private markets were significant, reaching €1.6 billion year-to-date in 2022-21, and the group is actively working towards its target of having 15% of total AUM derived from private markets. 21. The firm is aggressively pursuing innovation to solve the structural limitation of illiquidity inherent in private assets. The strategy involves restructuring access to these assets through sophisticated product design. 22. Specifically, Azimut utilizes hybrid strategies that combine traditional illiquid asset classes, such as private equity and private credit, with engineered liquidity mechanisms or liquid sleeves. These structures often comply with new regulations like LTIF 2.0, allowing high net worth individuals, HNWI, and retail clients to gain exposure to alternatives while mitigating the traditional liquidity constraints. 22. This innovation enables Azimut to build long-term exposure to alternatives while providing investors with greater control over capital deployment and duration, differentiating its offering in an increasingly competitive space. 3.3. International expansion as a growth engine. The international component of Azimut's business is rapidly becoming a more powerful engine for growth and value creation. 3. Management has set a highly ambitious goal, projecting global average total assets to grow from approximately €54 billion to between €95 billion and €110 billion by 2030. 3. Achieving this effectively requires doubling the firm's asset base. The strategic focus is heavily concentrated on the Americas, which is expected to contribute between €2 billion and €3 billion in annual inflows. 3. This ambition is anchored by the acquisition of North Square Investments LLC, NSI, in the United States, a transaction announced in July 2025. 4. The integration of NSI is expected to add approximately $16 billion, or about $14 billion, to the asset base upon closing. 3. NSI is a strong functional fit, described as an integrated management and distribution company, 4, whose strong U.S. sales engine will be leveraged by Azimut's suite of global investment strategies, including private credit and private equity, 23. This partnership is designed to establish an integrated and scalable B2B2C platform deemed superior for the specific dynamics of the U.S. market, 4. Other key growth regions include the MEA and Asia-Pacific, driven by ongoing expansion in markets such as Egypt, Taiwan, and Singapore, and supported by robust results from strategic affiliates like Sanctuary Wealth, US, and AZNGA, Australia. 3. 3.4. The TNB Strategic Project, Domestic Transformation. Domestically, Azimut is executing a significant structural transformation through the creation of TNB, a new generation digitally native bank dedicated to wealth advisory services in partnership with FSI SGR SPA. 5. This transaction, initiated in May 2025, has a potential total value of approximately 1.2 billion euros. 5. A critical feature of the arrangement is the 20-year industrial partnership under which Azimut retains a 19.99% strategic stake, and TNB is contractually obligated to generate a minimum of 2.4 billion euros in fees for Azimut over a period of at least 12 years. 5. This arrangement represents a strategic de-risking maneuver. By transitioning a portion of its privatized distribution into a partnership structure, Azimut secures substantial long-term guaranteed fee income. This move materially mitigates the potential volatility associated with relying on non-recurring capital events such as prior asset sales to bolster profitability. 3. The certainty provided by the guaranteed fee structure, combined with the expected capital gain from the transaction, allowed Azimut to update its 2025 net income target to a highly ambitious level of approximately 1 billion euros. 5. IV, Financial Performance and Operational Efficiency. Azimut's financial profile is defined by rapid revenue expansion and outstanding capital efficiency. 4.1. Revenue Quality and Growth. The firm delivered the highest revenues in its history in FY 2024, rising 12% year-over-year to 1.5 billion euros, FY 2023 1.3 billion euros. The quality of this growth is high, demonstrated by the solid 11% year-over-year increase in recurring fees. Furthermore, performance fees increased 2.6 times compared to 2023, reflecting robust investment returns delivered to clients across mutual funds, managed portfolios, and pension products. Contributions were geographically broad, with strong performance in Australia, Turkey, Brazil, and Switzerland, alongside domestic growth driven by private markets and advisory solutions. 4.2. Superior Profitability and Margin Profile. Azimut demonstrates high operational efficiency consistent with a leading asset manager. The trailing 12-month TTM operating margin as of October 2025 was 52.76%, 9. While high, this represents a slight compression from the FY 2024 operating margin of 61.06%, 9. This fluctuation is partially attributable to necessary cost increases associated with global expansion, higher variable incentives tied to recurring revenue growth, and extraordinary expenditures related to the TNB project. The TTM net profit margin is exceptionally strong at 41.46%, 24, culminating in net income from continuing operations of 591.23 million euros in 2024. Exceptional return on equity. One of Azimut's most compelling financial characteristics is its sustained high return on equity, ROE. The TTM ROE, October 2025, is 26.35%, with a normalized ROE of 26.51%, 8. This level of return is outstanding in the financial sector. The high ROE is structurally superior because it is achieved with minimal financial leverage. Since the debt-to-equity ratio is negligible, 0.01%, 6, the high ROE is not the result of leveraging equity with significant debt. Rather, it is purely a function of exceptional operational performance and robust net income generation relative to its equity base, 6. This indicates a high-quality, resilient ROE driven by margin efficiency rather than financial engineering, offering a stronger foundation for sustained shareholder returns. V. Capital structure, cash flow, and dividend sustainability. 5.1. Balance sheet strength and liquidity. Azimut maintains an extremely conservative and robust capital structure. As of June 30, 2025, total assets stood at €9.99 billion and total liabilities at €8.18 billion, 7. Crucially, the total debt is minimal, 118.0K, 6, or 0.02B, 7, resulting in a debt-to-equity ratio of only 0.01%, 6. This minimal leverage eliminates almost all financial risk, confirmed by an extremely high interest coverage ratio of 137.7x, 6. Furthermore, the company holds substantial cash and short-term investments amounting to €407.1 million, 6. 5.2. Decoding cash flow dynamics. A complex point in Azimut's financial reporting is the occasional divergence between high net income and periods of negative operating cash flow, OCF. For instance, in FY 2024, the cash flow generated/absorbed during the period was negative, recording negative $139.7 million, 17. This apparent paradox is a characteristic feature of accounting in the asset management industry. Negative OCF often arises due to the timing mismatch between the recognition of non-recurring performance fees as revenue and the immediate corresponding outflow of large variable incentives and distribution commissions, 17. These outflows are typically classified under operating activities, causing cyclical dips in OCF. However, the firm's overall liquidity is strongly supported by cash inflows from non-recurring activities, such as the proceeds from asset sales. Specifically, capital gains from transactions like the sale of the stake in Kennedy Lewis Investment Management and the AZNGA transaction, 3, significantly bolster overall cash reserves and closing cash balances, $749.6 million in FY 2024. Therefore, analysts must focus primarily on recurring net profit growth, which management emphasizes as the correct measure of core business health, rather than relying solely on fluctuating OCF figures. 3. 5.3. Dividend policy and sustainability. Azimut offers an attractive trailing dividend yield of 5.20%, 12. The dividend is considered sustainable, as the estimated payout ratio based on earnings is a comfortable 55%, 26. While periods of negative free cash flow historically occurred, 26, the firm's robust earnings coverage ensures the sustainability of the distribution, 27. Furthermore, management has consistently prioritized maintaining strong operational results and cash generation to support shareholder returns, occasionally utilizing a mixture of cash and treasury shares for payment, 17. V. Valuation and analyst consensus. 6.1. Absolute valuation metrics. Azimut's absolute valuation metrics suggest a significant discount relative to its financial quality. Market capitalization, approximately $5.48 billion or $5.03 billion, 12. Price to earnings, PE, the normalized PE ratio is low at 7.16x, 12, although some metrics place it slightly higher at 10.49x, 13. This figure suggests that the market assigns a low valuation to the company's strong current earnings. Price to book, PB. The PB ratio falls between 2.68x and 2.745x, 12. This multiple is appropriate for an asset-light financial firm, reflecting the substantial intangible value attributed to its AUM and proprietary distribution network. Price to sales, PS. Ranges from 3.72x to 3.946x, 12. 6.2. Peer group comparison, valuation discount analysis. A relative comparison against key domestic peers illustrates a pronounced valuation discrepancy. For instance, Banca Mediolanum (BMed), an integrated financial peer, trades at a PE ratio of 11.4x. The fact that Azimut trades at a discount, normalized PE of 7.16x to 10.49x compared to BMed, 11.4x, despite possessing superior financial metrics such as higher ROE, 26% versus NA for BMed, and an effectively debt-free balance sheet, implies that the market is applying a significant risk premium. Potential reasons for this discount include earnings volatility, historical reliance on performance fees, which are naturally volatile, execution risk, the complexity and scale of simultaneously executing the TNB spin-off and the NSI integration, geographic risk, regulatory and geopolitical uncertainties associated with its ambitious expansion into emerging and frontier markets, e.g., Turkey and Egypt. A successful realization of the TNB guaranteed fees and NSI synergies should lead to a convergence of Azimut's valuation multiple toward or above that of its domestic peers, justifying a substantial re-rating. 6.3. Analyst consensus and technical view. Based on projections from 7 analysts, the average 12-month price target for Azimut is €35.06, with a high estimate of €41 and a low estimate of €30.70, 14. Based on the recent trading range, this target implies a marginal upside of plus 0.59%, 14. However, the overall analyst consensus remains a buy, 14. Technical indicators further reinforce a positive short-term outlook, with a daily signal categorized as strong buy, 31. 7. Key investment risks and mitigation strategies. 7.1. Execution and integration risk. The simultaneous execution of the TNB and NSI transactions poses a substantial risk. The TNB project, while strategically critical, faces potential delays, with closing possibly extending into the early months of 2026, pending regulatory approvals. 10. Delays or failure to fully realize the anticipated cost savings and synergies from the NSI integration could impair the projected AUM growth and disrupt the ambitious 2030 AUM doubling target. Management mitigates this risk by emphasizing the strategic fit and cultural alignment of the NSI acquisition, 23, and, critically, by structuring the TNB deal with a long-term guaranteed fee component designed to stabilize future income streams. 7.2. Regulatory and market headwinds. The asset management industry in Europe continues to operate under increasing regulatory pressure, including the escalating compliance burden imposed by mandates like MiFID II. Furthermore, the industry is grappling with persistent fee compression driven by the prevalence of do-it-yourself (DIY) investment options and rising technology costs required to combat complex cyber threats and meet reporting demands. Azimut addresses these challenges by maintaining its focus on high-value advisory services and scaling up specialized product offerings in areas like fintech and alternatives, 18, which inherently command higher, more defensible fees than commoditized public market products. 7.3. Private markets illiquidity and valuation risk. Azimut's strategic focus on increasing the proportion of assets under management dedicated to private market funds introduces inherent illiquidity risk, particularly for its retail and HNWI client base. 22. This asset class typically involves longer duration and restricted access to capital. The firm actively mitigates this structural drawback by pioneering product innovation. By utilizing hybrid strategies, Azimut structures vehicles that combine private assets with a liquid sleeve or engineered liquidity mechanisms, such as NAV-based partial redemptions. 22. These structures are strategically developed to comply with regulations like ELTIF 2.0, allowing broader distribution while providing investors with increased flexibility and control over their capital. 22. 7.4. Interest rate sensitivity. Sustained periods of elevated global interest rates can negatively affect global asset valuations and potentially slow AUM growth momentum. 33. However, the structure of Azimut's insurance business, Azimut Life, primarily consists of unit-linked products without guarantees. This structure means that the investment risk associated with changes in market rates is borne by the policyholder, fundamentally eliminating the asset-liability mismatch for the company. 34. The global distribution model and presence across diverse geographical hubs and asset classes, public and private markets, provide inherent diversification, enabling the group to proactively adjust active management strategies to mitigate adverse macro environments. 16. 8. Conclusion. Azimut Holding SPA presents a unique combination of exceptional financial robustness, near-zero financial leverage, 26% ROE, proven operational excellence, AUM inflows double that of peers, and a compelling growth strategy centered on international expansion, NSI, and guaranteed recurring revenues from its domestic strategic pivot, TNB. The current valuation, particularly the low normalized PE ratio ranging from 7.16x to 10.49x, suggests that the market has not yet fully factored in the stabilizing effect of the $2.4 billion guaranteed fee stream from the TNB transaction or the distribution synergy potential of the NSI acquisition. This discrepancy, viewed against the backdrop of Azimut's superior margin profile and high-quality earnings, implies that the stock is materially undervalued relative to its intrinsic value and relative to domestic peers. The strategic innovation in private markets, specifically the use of hybrid funds to address illiquidity risk, is expected to accelerate AUM growth in this high-margin segment. While execution risk remains the primary immediate concern, the contractual foundation of the TNB deal provides a measurable buffer against future volatility. The potential for material multiple expansion, driven by successful integration of NSI, realization of the long-term guaranteed income from TNB, and continued outperformance in asset gathering, makes Azimut Holding SPA a high-conviction investment for sophisticated investors with a medium to long-term horizon.